Stock, bond and currency markets continue to ponder what is going to happen to the UK economy, not least in the context of the coming budget this autumn. Soggy GDP growth numbers, the Labour rebellion on welfare payments and the relatively slow rate of decline in UK interest rates all raise questions on whether Chancellor of the Exchequer Rachel Reeves will be forced to reassess her and her party's plans for spending and taxation. Both issues matter on a direct level for advisors and clients too when it comes to the value of their investments and their personal finances more broadly. It's too early to judge whether the Chancellor can both stoke growth and meet her own fiscal rules on government borrowing. In the case of the latter, the aim is to match day-to-day spending with income from taxes and reduce the aggregate deficit as a percentage of GDP in a 5-year low. After about a year in office, it's too early to say whether she and the Labour Party can succeed, but the strain already seems to be telling, judging by the Chancellor's tearful appearances in the House of Commons amid July's backbench rebellion over welfare reforms. The UK government bond market does not sound convinced either, given how the yield on the benchmark 10-year gilt is higher than it was at the time of Labour's general election victory in July 24, even though the Bank of England base rate's down over the same period. Advisors and clients may ultimately look to their portfolios to gauge the effect of Chancellor Reeves' policies, and in this respect at least she's off to a decent start, despite President Trump's tariffs, war in the Middle East and turgid UK growth figures. The Chancellor's Leeds reforms package generally drew praise, albeit of the lukewarm variety, and the FTSE All-Share is up by some 13% since Labour took office last summer, again that's outpaced inflation. Rachel Reeves is the 21st Chancellor of the Exchequer since the inception of the FTSE All-Share Index in 1962, and the 6th member of the Labour Party to hold the post during this period. She's already outlasted 4 of her predecessors, all of whom are Conservatives: the ill-fated Ian MacLeod, Kwasi Kwarteng, Nadeem Zahawi and Sajid Javid. Stability is always welcomed, and the Chancellor's first year in office represents a steady one for equity investors, despite some signs of unrest in the bond market and on the backbenches. The FTSE All-Share rose by 6.7% in nominal terms, or 2.3% in real post-inflation terms, in the 12 months after Labour's victory in the 2024 general election. Cooler inflation is clearly a plus here, and the rate of change in prices could yet define Reeves' term as Chancellor, especially if external events take a hand. A stronger pound, weaker oil and gas prices, and thus a lower energy price cap, and softer global trade could take some steam out of inflation and even cut the Chancellor and the Bank of England a lucky break. You never know. An easing in the rate of inflation and thus perhaps lower interest rates could yet benefit advisors and clients' UK equity exposure, although the opposite could yet apply too, given variables such as tariffs, wage growth and ongoing unrest in the Middle East and what that could in turn mean for energy prices. The gap between nominal and real inflation-adjusted returns from the FTSE All-Share Index under some Chancellors is truly glaring, and this is company that the current incumbent of 11 Downing Street may not wish to keep. Inflation had a withering effect upon advisors and clients' returns from the stock market under Labour's Denis Healey's chancellorship in the mid to late 1970s, even if his supporters would argue his record was tarnished by the need to tackle the mess left behind by the barber boom and the oil price spike of the early 70s. Inflation also chewed up the nominal gains made by the FTSE All-Share under Tory Chancellor Sir Geoffrey Howe and the aforementioned Tony Barber, who were in office between 1979 and 83 and 1970 and 1974 respectively. Not all of the inflation that tore through the British economy in 73-74 could be laid at the door of Mr Barber's policies, as the 1973 oil price shock had a huge amount to do with it, and this highlights the importance of factors which are beyond the control of any Chancellor, no matter how skilled or diligent. Alistair Darling could have hardly expected to inherit the great financial crisis, which prompted a deep recession and a wicked bear stock market. Norman Lamont inherited the British membership of the exchange rate mechanism, fought to defend the pound and a policy in which he didn't believe, and oversaw a devaluation of sterling which actually helped the FTSE All-Share to rally. Rishi Sunak had to contend with COVID-19 and the worst recession for 3 centuries. Maybe he got the worst hand of all. Even so, advisors and clients looking at the world through the narrow perspective of their portfolios will be wanting Rachel Reeves to think back to Barber and Healey. The Chancellor's desire for growth is totally understandable, especially as rapid nominal growth could help to shrink the debt to GDP ratio if borrowing and base rates are kept under control. But that's a big if. Should the backbench rebellion on welfare reforms be any sort of guide? Failure to rein in spending could raise fears of fiscal profligacy and, in a worst case, a situation where suppressed interest rates and even money printing come into play as tools to make the aggregate debt manageable. Further increases in 10-year gilt yields and perhaps the gold price may yet give advisors and clients a valuable steer as to the likelihood of any such scenario.